Welcome back, traders. Thanks for joining me here today.
The next long-term pattern on our list is the flag chart pattern. This long-term pattern can exist as the bullish flag or the bearish flag. The flag price action pattern is a continuation pattern that occurs after a brief pause in the trend following a strong higher or lower price movement. This is one of the most powerful and reliable long-term chart patterns. The bull flag chart pattern looks like a downward sloping rectangular channel denoted by two parallel trend lines against the preceding trend. While the bearish flag chart pattern looks like an upward sloping rectangular channel denoted by two parallel trend lines against the preceding trend. The flag chart patterns are made up of three components, which are: number 1, the flagpole; number 2, the channel called the flag; number 3, the breakout point for the continuation. As we can see on this price chart, the flagpole is the initial price move. It can be represented by either an uptrend or a downtrend price move. In an uptrend price move, it's called the bull flagpole, while in a downtrend price move, it's called the bear flagpole. The angle of this price move is irrelevant in terms of the validity of the flag pattern. The distance of the bull flagpole price move should be measured from the last low swing upward to the highest peak of the pole, while the distance of the bear flagpole price move should be measured from the last high swing down to the lowest trough of the pole. This flagpole price measurement can later be used to forecast the potential measurement objective of the price movement from the breakout point of the flag chart pattern. Here's an example of the bullish flag on this chart here. To determine the flagpole, we would measure from the swing low here to the high of the swing here. For the bearish flag, to determine the flagpole, we would measure from the swing high here to the low of the swing here. The flag of the pattern is the key factor to this pattern. The flag needs to be well formed. Remember the key factors essential for the validity of a channel chart pattern. One of the key factors is that a reliable channel must have at least 4 contact points of price rejection. The same factor is applicable to the flag of this chart pattern. This is the point at which the market consolidates for a period of time, after a strong move in price. The period of consolidation is irrelevant. However, technically the longer price consolidates within this period suggests a higher possibility of an aggressive breakout. As we can see, after a long period of consolidation here, price broke out in an aggressive price move. The breakout is the point at which the market has finished consolidating and is now trending in the original direction. Using the distance we calculated for the flagpole, we can now have a measured objective for a possible target. How can we trade the flag patterns like a pro trader? In my personal opinion, there are 2 effective ways to trade the flag pattern formation, which are: number 1, during breakouts in strong trending market; number 2, waiting for a retest after a price breakout. How can we trade the flag pattern breakouts? Let's take, for instance, the market is in a consolidation phase in its flag, and then finally price breaks up or down. Next is to study the momentum of the 3 or 4 previous bullish candlesticks before the bullish candlestick that led to the breakout. Also, if there is a formation of a higher low swing before the bullish candlestick that led to the bullish flag breakout zone, As we can see here, there were strong bullish momentum and the formation of a higher low swing to the breakout here. You could have bought the bullish breakout candlestick here. Likewise, in a bearish flag pattern breakout, study the momentum of the bearish candlestick before the bearish candlestick that breaks out of the bearish flag. If the bearish breakout is accompanied by a lower high swing, then you can sell the bearish breakout candlestick. This is an aggressive entry approach trading strategy. It's advisable traders risk less when applying this entry strategy. The safest zone to implement our stop loss for the breakout trading strategy on the flag pattern should be at the last swing, which led to the pattern breakout here. The second entry trading strategy for conservative traders is the retest entry. Whenever the price breaks up or down of the flag, the best time that you want to trade the flag pattern is on the first pullback. When you see that a pullback is forming, this is the best time to trade the flag pattern. As we can see in this bullish flag here, after a bearish retest, the resistance trend line acted as a new support for price. Conservative traders would have to buy at this point here. Here is an example of a retest on the bearish flag breakout here. We can see how the broken support trend line of the flag is proofed as the new resistance for price. The safest zone to implement our stop loss for the retest trading strategy on the flag chart pattern should be slightly above the high of the point of the retest of validation here. Where should we implement our take profit target based on the flag chart pattern trading strategy? Setting take profit depends on 3 techniques, which are: Number 1. Measurement objective. This is the act of replicating the measurement value of the flagpole of the chart pattern from the point of breakout upward to forecast the potential bullish move of the bullish breakout, and replicating downward from the point of the breakout for a bearish flag pattern. Number 2. You can trail profit with indicators such as moving averages. Number 3. You can target the next key level structure as your point of profit objective.